Hi, I'm Apurva Sheth and I welcome you to yet another insightful episode of the Right Choices with Oracles of the Last Street. Over the last 2 years, we have been consistently inviting market experts and sharing actionable and insightful strategies with you so that you can become better investors and traders. This week, we have a very insightful and knowledgeable person with us. He has more than 25 years of experience in the market. He is a very popular technical analyst, television host, and a financial journalist. Currently, he is associated with Studio and News Channel where he is a business editor. Apart from this, he has been a believer of technical analysis and he's been practicing technical analysis for more than 20 years and he has also trained more than 5,000 students in technical analysis. Currently, he's also associated with Velocity Advisors where he's managing family funds and the AUM size is around 330 crores. So let's welcome Mr. Thoviti Brahmachary ji. Sir, welcome to the show. We are pleased to have you here.
Thank you, Apurva Sheth. My pleasure to join with you. I'll share my experience in whatever manner I can do.
Sure, absolutely. So you have been practicing and using technical analysis for more than almost 25 years. So how has the journey been in the markets along with technical analysis? So I'm sure you must have used charts on graph paper as well, and then moved on to the latest online versions and internet and computer-based charting. So how has the whole experience been?
Yes, I started, as you said, from the graph sheets to the DOS system, then Windows, all the versions. And now I'm almost subscribing almost five softwares now, including TradingView, which is the latest. I recently joined in TradingView. Earlier, I'm not with the TradingView. For that, I discontinued another one of the favorite software, Metastack. I discontinued recently. It was a wonderful journey because I started my first trend line drawing in '93. Still, I remember 93 September on a graph sheet. I learned it from one of the senior most banker. He was then GM of Andhra Bank, General Manager of Andhra Bank, Mr. Prasanna. And later on, journey is very wonderful. Then I learned from I am a firm believer of technology since 2005. Earlier, I used to have a lot of other things like I have to look at the fundamentals and other things, other aspects also. As a financial journalist, I'm accessible to all the managements located in Hyderabad. So that's another area where I have learned how the businesses works, how the fundamental changes, how the business environment changes. So I used to have a mix of fundamentals and the trading. So then later I seriously practicing 2005 onwards when the system has generated a lot of softwares came like Metastack has improvised versions done, and even AmiBroker was also a modified version has come up that by the time the new indicators has come up then. 91, I think before 1991, there is no candlesticks, right? And later on, we were most popularized in 2000 onwards only, the candlesticks pattern, Steve Nielsen.
So I think after computers came in, candlesticks started becoming popular because before that, drawing four things with hand on a graph paper which is small would be very difficult.
Yes, that time only bar charts and the line charts. These are the two things, and the P&F, pant and figure. These are the major things. Later on, there are a lot of other advanced studies have come up. And now I seriously follow the technical. I'm a classical chart pattern guy. I still believe as minimum as possible indicators. And I strongly study only RSI. Whatever the breakout or whatever the chart patterns, I'll reconfirm with the RSI. So my studies in RSI is when I headed Hyderabad chapters ATMA, Atma, Association of Technical Markets, my PPT paper was the only paper on RSI divergences at that time. So very few people had studied about the divergence. Now everyone knows divergence between price and the RSI, but that's not the case. There are some advanced levels, even RSI based. We can fix the RSI based targets also. Very few people know that. I'm a student of Andrew Cardwell. I can say proudly that I follow Andrew Cardwell methodology in RSI, which is RSI Edge. And there are a lot of studies have come up in RSI and other technical indicators. But ultimately, what you need is to identify a trend. And there are only 4 price action tools in the markets. So that gives that, if you can understand that, that's enough for you to make money in the markets. Whether you trade, whether you invest, whatever it is, how you understand the market price behavior. So that's the reason my topic is also like that. Only price trends and the trend trends and the stage analysis. Every price moves in the stages, right? So these are the facts only. These are the only 4 facts happens in the market. That is open, high, low, close. That's all. If you understand that, then everything is yours.
So out of all the things that have changed over the years in technical analysis, these principle or these these are all evergreen systems, principles. Yeah. So it will be like interesting to learn more about them from you who have been practicing it for so many years.
Yeah, I'll give one example. Now everyone draws the trend line, right? And everyone draws the channel line. But there is a very specific principle about the drawing the trend line and the copy and the clone it and paste it where to become a channel. That's an important thing. There is one rule is that if you find 2 bottoms or 2 edges, lows or highs, it gives a indication of a trend. If you draw a straight line from one bottom to other bottom, it gives the trend indication, right? And the third one, if you draw a third point, that's in a trend confirmation. And it tests 4 and 5 is your targets. 6th occasionally comes. 6th support or 6th resistance occasionally comes. 7th resistance or 7th support rarely comes. If it comes 8th time, it's a wonder. You can check it on any chart, on any time frame. Very rarely it happens. This fact has to be known by every trader. So drawing a trend line is not just one. It can there will be a whipsaws also. 1%, 2% whipsaws may be there. But drawing a trend line is a technique which I learned from the day 1 onwards. That gives enough material to you study. And if you draw a top and bottoms connecting, 2 tops and 2 bottoms connecting, there is a pattern comes, right? You try how do you find a symmetrical triangle or an ascending triangle or a descending triangle? Means just drawing a connecting 2 points in the top, 2 points on the bottom. That's all. The connections must be 4, 2 on the bottom, 2 on the top. The 5th one must be breakout, or 6th one must be. Not more than 7th will not come. So that's where you can find out these things will not have. We cannot find in the textbooks, or we cannot find in the.
This will come only with experience.
Technical analysis is nothing but observation. It is not a thing someone will give you some on a plotter. No, it is only an observation. It is in a mastery of observation, what we can say. So try to understand that your ultimate goal is to find a trend, right? That's what my PPT also said that.
Let's not wait much and let's jump straight into the PPT. I'm eager to learn about trends, trend lines, and price action from you. So let's start.
So our topic is today is the price trends, trend lines, stage analysis, and trend change. So our main goal is to identify a trend, write the trend unless it reverses, and the evidences says that it is a reversal. What are the evidences? There are several trend indicators are there, like moving averages. You can draw a trend line and other thing, right? So drawing a trend line and identifying a price trend is a very, very important characteristics here in the market. So now this is a formal disclosure for me because we are going to discuss several stocks charts also here. So those are, please, it is only for the educational purpose. It's not a recommendations. That's my disclosure. Though I'm a NSIM certified and working for many other things, no, I don't see it is only educational purpose. As a teacher, I'm going to give you a good knowledge about this thing. So in any trade, if you take any trade, these are the three things you should keep in mind: that mind, method, and the money. What are these three things? Your mind must be focused on commitment to your analysis, discipline to follow your rules, and review and analysis of your past trades. I can show my ledger book of 1991 and 92 are also. So that's where you can find your trades, so that you can find your own behavior. Suppose if you look at the last 1 month trades of your own, identify the what you are done, whether it's a mistakes or you are successful, analyze that, so that every mistake is you are a good teacher. You learn from it. Okay, that's the reason you should always follow the trade sheet and analyze that, where you why the stop loss are triggered, where it was consolidated, why you entered at certain level, and the knowledge. Now today's market is more of information, not the knowledge, right? There is, everyone knows today what is technical analysis, what is moving average, every indicator, every oscillator, every setup, everyone knows. But recent SEBI report says 89% of the traders are losing money, particularly retail traders. So knowledge is not a information. Information is completely, you can get it anywhere. Knowledge is completely different. Analysis is completely different. Technology is nothing but a mastery of observation. If you observe the price, you will find the various patterns and the repeated behavior. Humans are have the repetitive behavior. So whatever we did earlier, the same mistake we can do the later also. So every pattern can give you the similar results in the future also. So remember that. So first understand the price action and deep understanding of the indicators. One or two is enough, not more than that. One of your favorite indicator, master it, and two is enough. Don't go beyond that. Don't apply behind the two or more indicators. Otherwise, it will be a crowded chart. Okay. Economy, industry, company fundamentals also need to be studied, because your fair investment is behind 3 months horizon. That means short to mid-term thing. Now short term is 3 months, mid-term is 6 to 1 year, 6 months to 1 year, and 1 year above is long term. Now the new conditions have come up like that. And the money is the only tool to do this business. Simple, understand that. You should understand your risk tolerance and your personality, particularly your emotions, how fast you can react to the price action. That's an important character of a trader. If you are a lethargic, complacent, you are not suitable for trading. You can go ahead with investment with a longer time frame. But if you are trying to be a lower time trader, then your personality is major benchmark. What we can say is benchmarking for your experience, trading style. Okay, and the setup and the trigger rules you have to find within the money. That means risk reward ratios or stop loss and exit rules. You must follow them at any cost. Okay. Now the basic fundamental is identify a trend, buy the strength, exit the weakness. This is a basic rule. Okay, and the stronger tags always lead the market and forms the new highs. Okay, and identify the stock which never made lower low. And one low is okay with a small whipsaw on a monthly chart or a weekly for the short term. Short term in the sense next 3 months to 6 months.
6
months.
months.
So that's all. If we are going behind 6 months, then go for a monthly and weekly charts and the multiple time frames. And every time you buy a stock at the new high only, every time if you buy a new high stock, then you will never lose the money in the market. So I have given a perfect example. This is the Asian Paint stock chart on a monthly monthly chart. Since 2009, it never made a lower low. Now the same Asian Paint is now stage 3, which I've discussed recently in one of my session. So this is the stage 2 of rally from started in 2009 to 2022 and okay. So this kind of money you can made in the long term. See, it's roughly about less than 200 rupees to 2000 rupees. That is 10x in just 11 years time frame. Okay, and the time frames and the weeks and months, you should always never look at the real-time markets. If you are investor, want to gain at least 20% CAGR for over a period of time, then you must look at weekly and monthly charts only. Daily for the exits, daily time frame for the shorter period for the exits only. Techniques to be used only pattern, indicator, one or two indicators, and the fundamentals you must look at. And the advantage here is if you are entering at the higher levels, high profits when adding winning position. Every breakout, every new high break is if you add the positions, then you will be winning the market, and there is a higher CAGR will come out in the only disadvantage is there. It needs a disciplined manner. Exit, we don't know when we are going to exit unless until it forms a stage 3 analysis. That stages also we will discuss in thing. Because people say buy low and sell high is it never happens. You should know, you don't know where is the bottom. There is a bottom formation that also we will discuss today. There is a characteristics of the bottom formation. A stock standard in the low means it is weak only. If the stock is hitting every time a 52-week low and sustaining about 10 to 5% here and there around the 52-week means the stock has weak in the technically, price technically, and the fundamentally it also it may be a weak one. So understand the bottom formations, where it forms, how long it can form, and you must wait until it transition into the stage 2. Okay, that is called as a this stage 1 is called as a that means 52-week and oscillating around 52-week low means it's a neglect phase, which where the stock is consolidating. The advancing phase is nothing but a stage to transition into the stage 2, where we must enter into that. This is the thing. Stage 1 is a consolidation where the neglect phase, everyone ignores the stock. Advancing phase is the stage 2, accumulation phase. Distribution phase is stage 3, topping phase, and the declining phase is the capitulation where the declines comes in that. Okay. However, the same market can be different stages from across the time frame. Suppose if I'm looking at the weekly chart, it may be a stage 1. Okay. But if you go to the daily chart or the hourly chart, the same thing will be a different stage. Okay. Maybe it may be a stage 2 also. So identify if you are following one time frame, follow that only. Entry exit must be on one single time frame. For the precision entry and precision exits, you must follow a lower time frame, which is you are comfortable at. Now, this is the chart where I can say stage 1 is a consolidation because after a very sharp decline, the stage 1 consolidation happens, and then a breakout will go ahead with the stage rally. In this, from stage 1 to stage 2 transition period is very, very critical, important to identify now. So that rules also I'll explain about that. Once this enters into the stage 2, it rallies by base. Generally, any stage 2 rally will be sustained more than a year. Within this year to 2 years, sometimes it may happen more than longer period also. In this stage 2, the stock forms at least 4 bases, maybe a flat consolidation, maybe a cup and handle, maybe a double bottom, or sometimes it may be a consolidation longer than more than 15 weeks also. Sometimes it may extend up to 30 to 40 weeks. Longer the consolidation, sharper the move. Understand that. Okay. If the stock is consolidating in a tight range, more than 8 weeks, then the move, any breakout will give you a sharpest move. Your target will reach less than 1/10 of the time. That means a stock consolidates for a 10 weeks time and breaks out with a volume, then your target will reach in just 1 week time. That also I'll show you. Recent example, last week we have identified one stock which I've given yesterday, it was 20% in one single day move. This is an example. perfect examples of the stage analysis. This is the stage one base, rally, consolidated, and the decline. This is nothing but, if we can surprise, the stock is nothing but Adani Enterprises. Adani Enterprises, right? So every stage it has gone through. Again, now it is in a stage one consolidation, because any identify a stock which declined 60% plus from the top, from here to here, a decline of 60%, more than 60%, right? If it declares 80%, well and good. That well and good. Recently, this Adani Enterprises, the Adani Ports has declined 80%, 78.8% decline from the top. So identify these kind of stocks. Ultimately, what happens is it cannot be become zero. Then it consolidates about the retracement levels of the 38% to 50% retracement comes, and it consolidates for the longer period, more than a year. So if you look at the Adani chart now, the same thing happens. So after if you go to the this one, okay, so this fall is almost 80%, right? 75.72%, right? After this, what it is happening is it's consolidating. This consolidation will happen for a period. Maybe next 1 year it may consolidate. It is just I think 2-3 months, 2.5 months old now, 4 weeks and this is 1 month and 3 months. Now 3 months old consolidation only. So it can extend up to another 8 to 9 months. So then what will happen is it forms a stage one base and moves into the transition into the stage two. That process I'll explain in a different manner. See, this is the one of the best stock we ever entered in various levels. This is a stage one base, which is the neglect phase. No one bothers about investing in this kind of companies because it's hitting every time a 52-week low, oscillating around 150 and 200 DMA and sometimes 50 DMA. But it never moved in any trending manner, right? So we identified once it crosses, once this moving average is trending higher, and when we waited till this base breakout and we started accumulating around this level. So our stop loss is only this low. That is not much. When it was a 50 rupee stock, there is nothing to lose in that. Okay. When we accumulated here in this zone, this rallied massively up to 475 rupees from hardly 44.50 range. So this stage one base is very, very important to enter any stock and identify, put in a trade setups like 10-week average, 30-week average, and 40-week average. All must be trending higher, and they must trending higher on a ascending order. That means, see, the lowest one is the 200 DMA, and this one is 150 DMA and 50 DMA. All must be ascending order, right? So see, 50 DMA, 150 DMA, and 200 DMA. This order must be there. Once this moves higher, your stop loss is only this 30 DMA, 30 weekly MA. Okay, and moved higher in just I think 15 months we made about I think it is from 50 average price is around 48 rupees to 475 levels. When it formed a head and shoulder here, we started exiting the stock below the 50 DMA. And once this crosses below this 30 weekly averages, we exited 80%. And this breakdown, which is a head and shoulder breakdown, we exited all the positions, remaining 20% also. And decline, look at the decline. And the decline, after the decline, how it formed. So this is the stage one base again. This stage one base formed in a inverted head and shoulder manner. And then we identify a trade here, and one base, second base, and the third base. So this transition we need to identify. You be in the trend only in the stage two, or accumulate in the transition period of the stage two. That's all. You can make maximum money in those things only. This is not suitable for investing, and this is for an accumulation. This is for the participation. That's all. So this is another stock which is also a Dr. Reddy. We also stay invested, and this is a disclaimer here. And even now, today also it was broken out of a certain range here today. And this is the decline phase, stage 1 base, transition period, and the rally. Okay. And generally, transition, how you identify transition from the stage 1 to stage 2 is stock price moves above 150 and 200 DMA. If it is a weekly chart, 30 weekly average and 40 weekly average, 150 DMA must be about 200 DMA. And the 200 DMA has to be trend higher. A curvature must be higher, not the flat one. Okay. And not the down also flat. No. 200 DMA has to turn upside. Okay. And then series of higher highs and higher lows on the price. At least three lower highs, three higher lows and two higher highs is enough. Must be lower lows must be higher number. Three higher lows and two higher highs is enough to make a decision. And large weak ups in the volume spikes. Volume spikes must be above at least an average 40% above the average volume. A lakh of volume per day. Then it must register at least 40% above 1,40,000 volume must be registered on a spike. This is a stock which we are discussing just real time. This is the GE, TD, Okay. So it declined almost 88%, 87.87% from its lifetime high. In just how many days? I think it is in just 2 years time frame. And then it consolidated for 150 weeks. Formed a base. This moving average turned up in 3 weeks ago. It reached the previous swing high, the previous last week. We identified this range and accumulate phase is this one. This is the accumulation phase from here to this high. And yesterday it moved higher 20% in one single day. That's a sharpness because the consolidation is very long, 150 weeks. That means almost, suppose if you 3 years consolidation, you can say 3 years consolidation breakout given sharper. Simple rule in technical analysis is longer the consolidation, tighter the consolidation, a breakout gives you sharp move. Simple rule. There is no indicator needed for that. Okay. And then in accumulation phase, what is the accumulation phase? Is stock price is about 40 week MA or 200 DMA, and the 200-day moving average is uptrend, clear uptrend. 30 week is also above the 200 DMA, and the stock price is clearly in uptrend in a staircase manner. That staircase is nothing but higher highs and higher lows. Okay. And the short-term moving average above the long-term moving average. That means 50 DMA always above the 150 and 150 almost above the 200 DMA. That's a setup. That's a standard setup. And volume spike in big up days. Every high spike, suppose if a stock is moving higher by 3%, 5%, the volume must confirm. The volume must be higher. That shows more and more buying interest is coming inside. And then if you look at this chart of the pre-call, so every breakout with an above average volume, right? So even the recent one also, this is an above average volume. So once this spike, longer the consolidation, spike is also higher. Suppose if you look at this chart on a trading view, I'll show you that on a pre-call, where is, yeah. So this is almost 25 week of consolidation. Okay. This 25 weeks consolidation of a tight range has given the pattern target of this height as given in just 1, 2, 3 weeks only. So that's the way we can identify the basis. So this is in the stage 2 base, stage 2 rally. Now there are already 1, this another base, 2, 3. So it could attract another base roughly around this level, 280 to around 220. There may be another base may happen. So it cannot run straightforward way. So it reaches, once this pattern target reaches, then it consolidates for another, forms another base, maybe a cup and handle, or maybe a pennant, or maybe a flag, or maybe this flat box range, and then moves higher. So any stage 2 will have 3 to 4 bases. Fifth base cannot be trustworthy. Fifth base maybe leads to a distribution of the stage 3. So better don't go behind 4 bases. 4 bases is good enough to make to stay in the stock. So if you buy this stock on a stage one breakout here, around 58 rupees, okay. So this is a breakout with a higher volume and moves higher, consolidate here, counter trends, and moves higher, consolidate, and moves higher, consolidate higher. So we are in the third base. There may be another base here, fourth base. On a breakout, immediately after meeting a target, we can exit. This is our target of around 320 to 340 in the shorter period. And in the same case, similar case in the even in I think Kirloskar also in the same manner. Even the GE shipping, whatever it is, this is a cup and handle formation. After a stage one base breakout, it retests the breakout, moves higher, base, and moves higher, counter trend on a cup and handle formation, a breakout this way on a above average volume and moves higher. Once this moves higher, and again we will test the target of another about 982,000 rupees. That's the way we can identify the trends. Trend is not only the higher highs and higher lows. There is consolidations, counter trend consolidations after a spike. Those consolidations may be in the flat base or a tight consolidations or in a cup formation or in a cup and handle or double bottom formations. So I'll show you one double bottom formation here. So this is the double bottom formation here. Okay, this is nothing but Manappuram Finance. Here the volume is little on a breakout. The volume is not so great. We cannot trust this breakout, though it is a double bottom, though it is an uptrend. For a fresh entry, we need to wait for some more confirmations on a volume front. Okay. This is a stage three. Particularly, we must be very cautious after reaching 4 or 5 bases. Thus, generally stock consolidate for some period. In that consolidation on the top, it may form head and shoulders on the top, or it may be a long consolidation with a high spike, high range, and the price volatility will be very high. It oscillates around 30 weekly average. And sometimes, many times, not sometimes, many times it drifts below the 50 DMA and moves higher again the 50 DMA. That volatility will be there. So I'll give an example for that also to you. Volatility generally increases on it, but earlier cases on the stage two basis, the volatility will not be much higher. There is usually major price breakdowns with an increased volume. That increased volume on a breakdown means it's a distribution. I understand that if a price declines more than 0.5% and on a higher volume, that is called as a distribution day. How you identify a distribution, whether it's a distribution or an accumulation? If the price declines, if it is index, it is 0.25% enough. But if it is stock is declining more than 5% to 1% with a higher volume, that is called as a higher than the previous day volume. That is called as a distribution day. If the topping formation, if the distribution days are more than 5 in a period of 20 to 30 days, suppose for example, then you consider it as a topping formation. Okay. And the largest weekly decline since beginning of the high volume thing, then consider it is going to be one of the breakdown is going to come in the stock. Stock may undercut the 200 DMA, below 200 DMA after the cutting 50 and 150 DMA. And 250 DMA will lose the momentum. Sometimes it's flattened, sometimes it's trend down. So generally, most of the people understands about the moving average is a price. If the price is above moving average, is a bullish thing. No, don't do like that. If the price is above the moving average, at the same time, moving average has to be trend higher, trend upside. Then only consider it as an uptrend. Understand it? Price moves above the moving average, but the moving average is flattened or down. It is not a breakout. It is only thing. Along with the price, moving average also has to be turned upside. Then only we make a decision of the bullish thing. Like that, on a short side, if the price is below the 200 EMA and 200 EMA whether flattened or a downtrend, then it is a breakdown. Look at this. This is a Dixon chart. So look at the spikes, volume spikes, okay? This decline is on a huge volume, on a weekly volume. Undercuts this 10 weekly average many times, right? And once this decline happens, once this triangle descending triangle breaks down, the stocks decline sharply. Still, it hasn't made any higher high, a swing high. Still in consolidation. This is stage 3, and we are into the stage 4 thing. Got it? So this all the consolidation. This is a stage 2, stage 3, stage 4. We are in the process of stage 4 because it is still below all the key moving averages. And I can show you this here in one example of Asian Paint, which was my favorite stock earlier for investment. Now we came out of this stock because there are several reasons. We look at the monthly chart of this Asian Paint. Okay, after a big rally from 2008-9 onwards to here, now this is the process of a double top formation.
This is a classical distribution top.
Yes, exactly. The classic distribution flat. If at all the stock declines below this, that means it is roughly about 26,600, then better not to stay in the stock. It is classical double top formation and decline trading below the 10-week average, 150 DMA, that is 30-week average. This is 40-week average. If it declines below this, already this 10-week average is in downtrend. This is going to be flattened. This is going to be flattened if this declines, and better exit the stock. Now we are not in a position to buy this stock. Maybe short term is different, completely different. For an investment decision, it is a topping formation. Okay, topping formation means nothing but a stage 3 formation. Once it enters into stage 4, by declining below the 40-week average, you get up to the stock. Never hold even a single stock in that. Wait for the stage 1 base, and this transition period you accumulate again because it's a quality stock. There are a lot of industry dynamics happening fundamentally because new players are coming. MRF has come into the paint industry, and the Grasim has come into the paint industry. There are several players are making entry into the stock or into the sector. Earlier, it was only a few stocks which were leading the sector. Now there are many leading players with a brand value has come into the sector. Stay cautious in stock. Okay.
So that's all in this episode with Mr. Thoviti Brahmachary ji. In this episode, we have covered everything about stage analysis. So stage analysis is one of the very popular methods used by classical technical analysts. And I'm sure in this episode, you have got several nuggets and wisdom from Mr. Brahmachary ji. So in the next episode, we will continue this conversation forward and look into many more finer aspects and look into other features and other things that Mr. Brahmachary ji looks at in the markets. So let's meet in the next episode. Until then, do subscribe to our channel and stay tuned. Thank you.